much for being with us on Retire Smart Austin. I'm Brad Johansson with Phil Capriotti Sr. in Power, Wealth, and Tax. How are you, my friend?
Brad, blessed. How you been? You know, it's been a long time since I've seen you.
Well, it's been a long time since we've had a chance to sit together. Do you realize, folks, you probably do realize this because you've been watching Phil forever. We are nearing show 200 for you.
It's amazing,
You
isn't it?
realize that? That you've been helping people this long, and they've got a chance to watch you on Retire Smart Austin almost 200 times.
You know, it's amazing because it feels like we just started this yesterday. And originally when we started doing TV about 5 years ago now, I figured we'd do it for about a year.
And it'd be good.
Yeah, it'd be something new. Do a little radio, a little TV. And it got so popular, they added a second station. So now we're on Fox and we're on NBC on Sunday mornings from 10:30 to 11.
People cannot get enough of you.
Well,
cannot get enough, Phil.
What I'm noticing, Brad, is we're getting a lot of referrals come in from our existing clients telling folks, hey, watch my advisor. He's on Retire Smart Austin on Sunday mornings, or listen to him on KLBJ. And the word gets out. You know, we just had our very first retire-free client party. And you know, when I came up with this idea, I was talking to my staff, and this was about 7 months ago, and I said, you know, over the last 15 years, since 2010, we have executed Roth conversions for literally about 600 or 700 clients, not to mention people we don't work with. So we've done over thousands of plans. And I said, you know what? What I want you to do is I want you to go through our database. I want to know how many of our clients are totally tax-free. How many have just started their Roth conversion strategies? How many have been doing them for 2 years, 5 years, and so forth. So we had a party. We invited, we found out there was over 450.
Goodness.
We had 138 clients show up at the Horseshoe Bay Yacht Club. Many of them brought guests, and we had a wonderful, wonderful time. So it was dinner, it was music, it was open bar. I had everybody staying in suites overnight. I didn't want anybody driving, and everybody said, we got to do this again next year.
They did.
Well, I told the staff, I said, okay, now this was the first annual, now we're going to do it each and every year.
Right, you're leading me into the perfect season, because 'tis the season for taxes. This is what we're going to talk about, and it's not tax prep. We're going to talk about tax planning, which is why you're partying. Because you've taken hundreds of people now through this to say, let's do this differently. For most, probably, you had said, you know what, my biggest fear going into retirement is going to be my medical costs. And that may still be for a lot of people. But probably the greatest fear for a lot of people now that they don't even know about, and maybe something that we're dealing with that we don't understand, is the taxes that we have, because we've got a partner in our retirement that we don't really want. I want to take us through this tax planning, not tax prep. When you say you've got hundreds of people now tax-free, and people go, what are you talking about, Phil? What does that mean?
What that means, Brad, is many folks do not understand, and to be quite honest with you, the majority of the so-called financial advisors out there have very little knowledge with respect to how to structure a tax-free or tax-efficient retirement income plan for their clients. The very first thing it starts with is what we've paid into Social Security for the last 30, 40 years. So you have to understand Social Security is at the very most, 85% of it can be considered taxable.
Right.
Well, we show folks strategies on how to make 100% of it tax-free. So here's the idea. If you take that IRA, that 401k, any qualified plan where you still have a partner, Uncle Sam, and you start executing Roth strategies, conversion strategies each year, What happens is the more money you take from the Roth, the more money you get from Social Security,
Yeah.
and the more you take from your Roth causes your Social Security to have a zero or negligible tax effect. So let me give you an example. Most of my clients that have worked hard, saved, and getting ready for retirement, they might retire at 62, 65, it doesn't matter. Their advisors tell them, for the most part, file for Social Security as soon as you can. Many of them do. You'll collect it for more years, and in the end, you'll be better off. The break even works out. Nonsense, it doesn't. Because Social Security, taxation on Social Security is based on this formula called provisional income. Any money I take from a Roth IRA causes my Social Security not to be taxed. So if I have $60,000 coming from Social Security between my Social Security and my wife's, and I have say, $100,000 goal retirement income, and I pull $40,000 of earning from my Roth
Yes.
with the Social Security, none of my Social Security is taxable. So now, pardon me, I have $100,000, okay, between Social Security and Roth that I give zero back to the government. So what we do is we help folks understand if you take money from your IRA and maximize your Social Security, at the end, you're going to end up paying $10,000, $12,000, $13,000, $14,000 in taxes just because of the taxes on the Social Security. If you take that money and pay the taxes on it and convert it to a Roth and then use that Roth for distribution planning and retirement once you turn on your Social Security, very little, and in many cases, zero. None of your Social Security is taxable income.
Here's what you said to begin with. Most of the advisors that people are dealing with are doing none of this. Have not even let anyone know about. I'm flabbergasted if you're saying that most of the people that people are dealing with and coming in are hearing about this from you for the first time. Why is that?
Because I believe most of the one of the big reasons is most of the advisors are not Ed Slott Master Elite IRA advisors, number one. So I have been an Ed Slott Master Elite IRA advisor for 18 years. So Ed Slott is a CPA who teaches individuals and investment advisors and how to structure tax-efficient distribution planning in retirement. You see, most of these advisors, they're all about accumulation. And distribution, they're not even thinking of taxes. What they tell you is go check with your CPA or go check with your tax advisor. Well, Brad, if your financial advisor is not also your tax advisor, you're really not getting your money's worth, in my professional opinion. So your financial advisor should, number one, be your fiduciary, always looking out for your best interest. They should be your tax advisor. You should be able to ask them legal questions within a certain realm.
Absolutely.
And they should be able to advise you right there. When I see advisors say, check with your attorney, check with your CPA, basically what that tells me is we have a lazy advisor. That's what it tells me. And either they're not knowledgeable enough to give that type of advice, which I believe is borders on incompetence, okay? Or the client is just not getting everything that they need to in retirement. So the advisor you worked with while you were accumulating investments may not be the right advisor you want to work with once you retire. If you're not structuring a tax-efficient retirement income plan, you're giving a lot more back to the government, and needlessly, because the planning was not there.
Here's my question to you. Are you seeing one of those advisors? Are you not getting everything that you're paying for? Or are you now, from Phil, hearing something for the first time that you say, maybe I need a second opinion? Here's what you have to do. Make a phone call, 888-818-6557 for a portfolio analysis. And you say, well, how much is that going to cost if I'm going to get all of this? It's complimentary for you to come into the office and work on a portfolio review and a portfolio analysis that lets you know what you've been missing out on. Because what you'd like to miss out on is paying the government taxes. Let's help you with your tax planning. As a matter of fact, Phil has now put together a tax calculator. We're going to get to that when we return.
Hello, my name is Phil Capriotti. You know, we have been helping folks like you create a tax-free retirement income plan for over 2 decades. I am a firm believer that if you've worked and paid taxes for the last 50 years, the one thing you shouldn't be burdened with is excessive taxation in retirement. At Empower Wealth and Tax, we specialize in helping you reach your desired retirement lifestyle with a tax-free and tax-efficient retirement income plan. With the probability of taxes going up significantly in the future, let's plan your retirement right. Call us today or select one of the options below and start empowering your retirement right now.
All right, here's what else you could do right now. Brad Johansson back with Phil Capriotti Sr., Retire Smart Austin. We're so glad you're with us. Your time is so important, and we appreciate you spending time with us. Empower Wealth and Taxes now put something together for you to make it easy. I mean, isn't that what you want in retirement, is something that's easy? So if you'd like to figure out what your taxes are, well, Phil's put it together for you. EmpowerTaxBill.com. EmpowerTaxBill.com. You can also scan the QR code to put you to the landing page, but EmpowerTaxBill.com is now a calculator. I apologize already, because once you see it, you can't unsee it. What do you get in this tax calculator that's going to help people?
Well, that's well put, Brad. So first of all, folks, you have to understand how to maximize your income, and that starts with maximizing Social Security and eliminating or minimizing the taxes on it. The more you get to keep, the less you have to take from other savings in order to achieve your goal of retirement income. The other thing you're going to find on this is how to go about avoiding penalties. One of the things that we see more times than not, or many times, it's getting a little less frequently, is folks are not calculating their RMDs, or they're forgetting to take an RMD, especially on that first year. So for folks that have to take an RMD for the first time, depending on when you're born, it's either age 73 or 74 or 75. What happens is, what we're seeing is folks taking their first RMD too early. They not only have to take the first RMD, because they're used to having to take the first RMD by December 31st. And so with the new tax bill, you have to take it by April 1st.
Yeah.
Now, one of the problems is that first RMD, you can end up taking your first RMD at April, May, and then you have to take the next one before the end of the year. So we'll see folks actually being forced to take 2 separate RMDs in the same year, which also blows up their taxes and many times their IRMA premium. Many folks don't manage their tax brackets properly, Brad. And so what I mean by that, folks, is let's assume for a moment you're getting $50,000 from Social Security. I'll have folks call our office and say, you know, I need to take $20,000, $30,000, whatever it happens to be, and they'll choose the account. Instead of asking their tax advisor, who should be their financial advisor, which account should I take it from? So we could take a look at the calculator and say, look, let's take $25,000 from your Roth and only $10,000 from your IRA. Or better yet, let's take some of the capital gains from your taxable account, plus we'll take money from your Roth because we don't want to blow up the taxes on your Social Security. So how you take money, what the different accounts that you have, because there should be 3 separate accounts, right? IRA, which hopefully if you've worked with us, has probably all been converted to a Roth IRA, unless you want to contribute RMDs to your specific charity. And then you have to take money from capital gains. Now, fortunately, due to the election, we're not going to see a major negative change in our tax code.
Right.
Remember, they wanted to make long-term capital gains ordinary income, and I won't go down that road. But the important thing is your advisor should be advising you not just about your wealth management, okay, what stocks and bonds and so forth to own, but where do I take the income to make sure my Social Security I'm receiving my Social Security tax efficiently.
All right, you talk about income sources. So we're talking about variable ways that we can do this in planning. Income sources become, well, I don't have an income anymore. That's kind of what you do, is create the income sources, the engine, as it would be, to kind of take you through retirement. You say there are different places to take money from, and that's the strategy that you work with that maybe a lot of others haven't.
You know, one of the strategies that we'll use, many folks will retire nowadays without a pension, Brad. They have 7 digits. Some folks come into our office, they got $5-6 million sitting in an IRA. Others have 500, 600,000. That's irrelevant, okay? But the point is they don't have an actual pension. They have Social Security, and then they have all this money in a 401k or a 403b or 457, still a qualified plan they haven't paid taxes on yet. And so what we'll do is if mailbox money is important to a client, and most folks want mailbox money, what we'll do is we'll put, say, part of that money in that 401k. We maybe might take 200 or 400 or 600 or whatever it is, put it into a certain type of fixed index annuity. And again, this isn't a sales pitch for it, but we'll do slow Roth conversions within that annuity. And over a 5-year period, let's say the number is 500,000, and let's say we convert 100,000 each year for the next 5 years. Well, by the time we turn on that increasing income, and all annuities, by the way, folks, should provide you with increasing income that more than covers increases in inflation. Now they get to turn on tax-free increasing income. So if they now have a Social Security plan that has an average COLA of 1 or 2%, and they have a Roth that's paid out as a pension with increasing income based on what their goal retirement income is, basically we can structure a plan that gives them 0% tax effect and in their mailbox money.
This is a strategy now that seems almost obvious, and yet when we deal with a lot of people coming in, nobody's ever talked to me about anything like this. This is different because it's a strategy. And when you talk about annuities, for a lot of people, that was a 4-letter word for a long time. Yep. Maybe a 4-letter word for them now. Why are they so different now than they were 10, 12, 15 years ago for people?
Well, first of all, many of the annuities back then, you couldn't make any money. I mean, they protected you against downside losses, but these things only average 2 or 3%. If your annuity's not averaging 7, 8, 9% a year, you're probably in a wrong product. So the other thing is when you turned on income, the insurance company was basically the primary beneficiary. Many folks turned on income of these annuities, and what they did was annuitize it. So they gave up control of the money inside of it. We don't want to do that. The other thing is a lot of these annuities provided static income, Brad, meaning they didn't give them increases each year. Most of the annuities that we will set up with a client, they have to provide tax-free income. Yeah. It has to increase by an average of 3 to 6% minimum each year, and it has to be once a Roth, always a Roth. Always has to provide tax-free income. And I need that annuity to be still earning 5, 6, 7, 8, whatever the percentage is, while they're collecting the income, so that if they live to 90 and there's still money left in the annuity, it goes to their children or their grandchildren. The insurance company doesn't keep it. Well, a lot of these older plans didn't have those. They didn't have those benefits and features in them.
Well, people are calling in now because that beautiful face of Phil Capriotti Sr. is up on a billboard. Are you in a bad annuity? And that's what you're finding is a lot of people are going, yeah, I'm one of those people. Can you help me out? Can you help people out of bad annuities now?
Yeah, big time. Most folks don't realize it, but just like with a piece of property, if you have a rental property, you can do what's called a 1031 exchange, selling one rental property, maybe it's fully depreciated, and buying another property. So when we want to do a 1031 exchange with real estate, well, with annuities, we can do a 1035 exchange. It's legal, it's approved by the IRS, and many times folks need to they need to re-engineer their retirement income plan, because what they bought 20 years ago does not fit today's needs, also doesn't provide for the returns of today's products.
Are you in one of those? Maybe this is your time to go, I need to make that call. 888-818-6557 so that you can come in and talk to Phil about whether or not you need to make an exchange. Maybe it's an exchange of an advisor right now who's actually telling you what you need. As a matter of fact, what we talked about, I want to put this up again, because if you haven't been there, you need to go. EmpowerTaxBill.com is where you need to be to find out what your tax implications are on your retirement, and how can we make a strategy to make it work for you. Let's put together a complimentary plan for you. 888-818-6557. We'll wrap up our taxes when we come back.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Phil Capriotti, CEO of Empower Wealth and Tax. If you amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. This is one of the greatest tax windows in history. Now is the time to take advantage of this tax discount while we can. We specialize in retirement income planning, tax mitigation, estate planning, and so much more. So plan your retirement right. Call now for your own complimentary portfolio review and tax analysis.
So glad you're with us on Retire Smart Austin. Brad Johansson with Phil Capriotti, and we are talking taxes today. We got into annuities. Does everybody need an annuity at this point?
Absolutely not. In fact, most folks, in my professional opinion, especially most folks that have accumulated quite a bit of wealth, okay, by the time they reach, they don't really need an annuity to structure their income, but they still need a tax-efficient income plan. So not every tax-efficient income plan has to have an annuity. In fact, I have folks, pardon me, who own annuities that have no right to have an annuity. So there are really only a couple reasons why someone would want to consider an annuity. Let's assume for a moment you have a taxable portfolio that's averaging 6 or 7%. Okay. And each and every year, and I see this a lot, we'll have 3, 2, 3, 4, 5 million in taxable taxable investments, okay, mutual funds and so forth. Yeah. And at the end of the year, they're getting a 1099 or a K1 for $70, $80, $90, $100,000. They're actually paying taxes on the earnings in that particular portfolio without even taking a distribution from it. So, and they're letting it just continue to roll because they don't need the money. They don't need the income. Yeah. But they're not shielding it against taxes. So they're paying taxes on money that is being earned, okay? And so right there, that's a non-efficient retirement income plan. So one of the tax strategies that we use, we have, and again, we stay state-of-the-art, current. We have tax-aware software. So our software will take that taxable investment account, okay, and twice a month or 3 times a month or once a month, depending on the client, we'll sell losses, sell gains to mitigate a 0% and then use that new money to buy new investments. So what that accomplishes, it accomplishes growing the portfolio, diversifying the portfolio, and doing it tax efficiently. Most of after they work with us for 1 year and they see this, how we do tax, it's really known as tax loss harvesting, okay? Once we show them how our software works, the very first question I'll ask clients, isn't your advisor doing this for you in your portfolio?
And the answer is almost always no.
This is the first time I've ever heard of it. How does it work?
This is probably the first time you've ever seen Empower Tax Bill empowertaxbuild.com as well. Empowertaxbuild.com is the place that you need to go, which is the tax calculator. So Phil's talking about the software they have in the office. This is more for you. This may tip you to say, you know what, I need to make a phone call because I'm looking at this. As I said, I apologize beforehand. You can't unsee what the taxes are that you have to deal with. And coming up with a strategy, how long have you decided? I mean, goodness gracious, you've worked in this for decades now, trying to figure this out. This has become the most important thing for people to keep their money. Finally, they get to tell their money what to do. That's the strategy behind all of this.
It is the strategy. And now, especially with the technology, even use of some of the AI techniques, we can now rebalance this portfolio. We can do it as quickly as daily, but that's too much. It's overdone. You know, too much of a good thing isn't any good at all, right?
Yeah.
So we want to strike a happy balance. So for folks who have large taxable accounts, I'm talking about stock portfolios, bond portfolios, mutual fund, muni bond portfolios. We want to look at not only rebalancing but diversifying, but we want to do it tax efficiently. So it's not always just Roth conversions.
Yeah.
Although what we're finding is when we structure a retirement income plan, and these folks start to see that that 7-digit IRA is going to spin off an RMD when they're 75 of 80, 90,000 a year, plus their portfolios are earning 80, 90, 100,000, plus they're getting Social Security of 60, 70,000. Maybe they have other income along with it. What happens is that RMD blows up their entire tax bracket. Yeah. It causes additional premiums with Part B and Part D IRMA. So many times, as soon as those RMDs start, we start to take a look at this, and they're like, I had no idea. The death of a first spouse, when you go from marriage filing joint to now filing a single return, and that surviving spouse has to take this huge 6-digit RMD because of what? Because we've worked hard, we've saved hard, but we didn't integrate tax planning and retirement.
And you may not have been aware of any of this. You see it on your screen. EmpowerTaxBuild.com. Go to that. That will make you make the phone call to say, I need help. That's what Phil's been doing for decades. 888-818-6557 to put together a complimentary portfolio analysis and tax review for you to make your retirement the way you want it to be. I'm so grateful you joined us with your time. Can't wait to see you here next time. And we can't wait to see you in the office. Thanks for being here.
Brad, thanks. God bless you, my friend.